Hey, yo, what's up, outliers? Happy Friday. Today is going to be a second session on the Surviving Options with 5K series. As you remember, the last stream we did, we decided that we're just going to do like a quicker overview of this as a general topic. And then we're going to move on to the higher voted topic for those that are actually on the stream versus the folks that voted on the community post. So this will essentially allow us to tackle two things. So the first video that we did in this mini series was just talking about a lot of the challenges in implementation methodology, I would say, for a small account. Now, the goal for the stream today is actually really fun, I think, because we're literally going to use on demand in Thinkorswim. We're going to go back in time and we're like legitimately going to try and trade the portfolio. So we're going to go through the process of building a portfolio using a $5,000 account and then hopefully doing a couple fast forwards in time so that we can explore the management of this style of account. So to that end, what I would like to do is begin with constructing the portfolio together. Now, I very purposefully have not looked really at most charts today. And what I was doing is thinking in the context of, okay, what kind of stuff it would be accessible to a small account? And the way that I want to start is by literally exploring the question set from that starting point. So let's outline the major muscle movements that we're going to have to execute in order to complete our task successfully. We'll bring this back over. There's a few things that we're going to have to focus on. This needs to stop like right there so that you can see the bottom. Now, let's just use this as like a blank spot for us to capture some notes. And the first question I have for you is we're literally about to build a $5,000 portfolio. So not talking about individual tickers, not talking about individual positions, but in your perspective, what are the first handful of things that we're going to need to do to execute this task? There's a couple major muscle movements that we need to outline that then we can modify a little bit depending on what we actually find, depending on when back in time we pick. So the short question is, what are the things we need to focus on when we're talking about building Bob the Builder? I don't know if that's a thing anymore. Bob building 5K portfolio. What are the things we need to do? What's up, Lauren, Jordan, Rutabaga? Great to see all of you. It looks like Lauren still got ran over on RKLB, got shaken out a little too fast. That happens sometimes. Prayers out to you. We'll pour one out for the homie. What kind of stuff can we think of? Well, you guys already know some of the first stuff. The first assumption here is that if you're trading a $5,000 portfolio, we need to focus on process. We're not necessarily emphasizing the dollar return because the dollar return doesn't matter. The percent return matters for a small account upfront. So percent return focus. Then we also know that we're going to have to make some decisions. So the first one is, what is our annual target? And this one's easy because for a new trader, we already know greater than 0 is good. In the context of what we're going to do in this demonstration, I'm going to approach this as if this is not a brand new trader. And this is somebody that has at least a little bit of experience. So let's say that we're targeting somewhere 8 to 10%. Why 8 to 10%? Great question. It's because this is the long-term market average. So one of the things I think makes a lot of sense for a new trader is first, be greater than 0, focus on the process. Then once you are able to be greater than 0, we want to start scaling ultimately to where we want to land. So let's say our ultimate target is 20% per year, whatever. Well, going from 0 to 20 is a big jump. So a really great interim step is to see if you can pace the market. And a big thing that I would be looking for in pacing the market is, can I do it with lower risk? And this is measured by volatility. So what I mean by this is, if the stock market returns 8.5% on that year, however, you return 8.2%, I wouldn't inherently consider this a miss. I would then say, what was the max drawdown of this version versus this version, which gives me a simple risk-adjusted performance metric. You could use Sharp, Sortino, whatever makes you happy. This is just essentially a very base version, but it gives us super important context, because if we do this, let's say this had a 12% max drawdown, and let's say that we had a 9% max drawdown. Well, this is actually quite a bit better. I'll take this one over this one for sure. So that's the broader idea here. So now we know what our target is going to be to start, which will be this metric here. So this is our first thing we need to answer. The second thing we need to answer is risk tolerance. The risk tolerance for a $5,000 account is pretty simple, I think. There's no world where you will be able to pursue a really strong return without having a pretty large risk profile in front of you. The reason for this is because when we look at the market and we look at building a portfolio, there's going to be a ton of limitations that you have that you simply have to accept. So trying to define risk tolerance as the 30% max drawdown is unrealistic. It's probably not going to happen. So in the case of a really small portfolio, the way that I mentally would bucket it, as if like this is the total risk, I wouldn't trade that way, but I would prepare my mind to lose this entire amount. The reason why I'm saying that is because if you think of that and you're like, oh shit, I don't want to lose the 5K, then that tells me we might need to take some of this out, put it into something else, and then trade with the residual. With a small account, you kind of have to be prepared to lose that account. It doesn't have to happen, in my opinion. I don't think you need to go that route, but it happens in most instances. So to deny that, or to not at least acknowledge that as a potential route, to me is just a complete mistake. So our risk tolerance, instead, we know 30% probably isn't going to cut it. So maybe we target something like 50%. So this will be a 50% max drawdown. So that means our 5K account would be looking like $2,500. That essentially serves as the portfolio level circuit breaker. So now we would need to figure out what kind of strategies and stuff we want to put in the portfolio. We're just going to do that live because I don't want to waste too much time on the planning stuff. Although I will continually remind everybody, that's the bulk of the work we do here as traders, is plan. So I don't want to skip over that without making sure that that's known. We're just going to spend a little more time on the practical execution component here. So when I think of strategies in an account this size, I'm going to be, again, this is if I were personally doing this, like you saw me in the small stacks account, I'm using stuff like covered strangles, ratio diagonals, verticals, and then long options. That's kind of it. Like that's going to be the majority of this thing. And really, I consider long options in this bucket here, because most trades that I would put on in the context of a long option is mostly in the context of it can turn into a diagonal if I so choose. So this is kind of it. So now if I were to try to think about splitting out my portfolio as I typically would, there's core and speculative allocations. And there's a couple of different ways to do this. We all know the way that I typically prefer to trade this kind of thing for core is in some sort of index ETF which we'll have to talk about because that's going to be difficult for a small account to come up with a covered strangle. Might not be able to do it. For the core allocation, it might need to be done via a ratio diagonal. The covered strangle just might not be accessible yet. We'll have to see what we see when we go back in time. And then the speculative will be trading things like you're used to seeing me talk about, right? So running through earnings cycles, taking a look at directional opportunities based on momentum, trend, this sort of stuff. So let me take a pause here, and Thor is slinking towards the door, so I'm going to let him out, but perfect timing, because I wanted to ask you, are there any questions on what we've covered so far, on the build out, on the methodology, on the broad approach that I'm talking about? Are there any questions that we have up to this point? Let me open the door. Or do we generally feel, okay, so Lauren's good, Chase is good, beautiful, great, love it. So I'm going to clear this stuff off. I'll take a screenshot before I do that, just so that we have it. I have to. I just want to keep this for our reference as we go through this. And I'll add this here. Cool. And then this stuff we can kill. Okay. So we're good. Next step. We need to start thinking about what kind of stuff we're going to be able to trade. And this is where things are going to start getting annoying right out of the gate. So the thing that we need to solve for right to start is what kind of stocks are even remotely accessible for something like a covered strangle or a ratio diagonal. Either of those kind of things will be a little bit challenging to find. And again, that's the nature of trading with a small account. We'll figure something out. Now, what I wanted to do is maybe we could do like 2023, something like that. It depends. I feel, okay, so we could do 2022, which has a pretty big drawdown. 2022 was down 19%. 23 was up 23. 2020 was up 18. 2020 was a little bit anomalous. Trying to think of like a good representative year. The better stress test would be in like 22, but that almost requires a completely different methodology and approach. So I don't necessarily want to base this entire scenario off of that adaptation. Like that's a completely different thing that we would have to build out. So my inclination is to use 22. The only reason why I'm not going further back in time is because on demand has limitations in terms of like the ability to populate data. So I don't want to go back too far because then everything in there starts to get really wonky. So we'll start with 22. In the context of 22, we know we have hindsight bias going into this because we know 22 was an up year. Nonetheless, the ability for us to like tinker with this approach, I still think will hold absolutely fine. So let's do that. So we'll focus on 22. So the first thing we'll do is literally just hop in the good old time portal here, and we'll go back in time. And I'll take us back to 23, January 1st, the beginning of the year. This is good. So this is after the market had sold off a bit, coming from 22 bear market. So now we're able to start looking at some ideas. Now, the first thing that we need to figure out is like what kind of stuff is even accessible to us with respect to trying to trade a covered strangle or a ratio diagonal. Now, the way that I would do this is I would conduct a scan. Now, I don't know if scanning works. It doesn't. So scanning does not work in on demand, unfortunately. So maybe we could just poke through the watch list and see if anything, because this looks like it's updating effectively. And maybe we can find some stuff here. I'm trying to see if IBIT was actually like tradable then. Because I think IBIT just got launched. Yeah, so that's no good. I think some sort of Bitcoin proxy would be nice though. What was QLD at? 34. Okay, so these will be okay. So QLD will be okay. TQs. Literally, this will probably where we'll go. So TQs will serve as the base for a covered strangle. This is based more on price. And this isn't like, if you see TQs below 20 bucks, I'm interested effectively no matter what, because the risk there is pretty contained. So this would allow us to trade effectively an entire covered strangle on it, with the caveat that if we want to get into shares, we can't let it run too far. So I would start with shares to begin the position. So let's start building what this portfolio might actually look like. And I'm going to grab this. This way we can have an actual look at the whole portfolio. This we don't need. This stuff we don't really need. This doesn't matter. This doesn't matter. These don't really matter. Okay. So let's start with the stuff that matters. So what I'm going to do is I'm going to actually break this down so that it's easier for us to see like what we're doing. But our first position, we'll start with the core allocation. The core allocation in the context of this portfolio should get most of the money. And I would, especially if it's something in like this, I would look to give it maybe 70%-ish of the total money. So we're looking at a $5,000 account. So we got 5,000 bucks. This is what we'll start with. Then we can take a look at our allocations. And again, this is, I wouldn't use this as law yet. I would simply use this as a starting point. No more, no less. So now we know loosely, again, to start, what allocation of the portfolio is going to get what. Most of this will obviously go into a covered strangle here, probably a little bit more, because in order for us to do a 2 lot, We would need to use 1672 upfront for the first purchase, which is what we'll do. And then to be able to sell a put, we'll need a little bit more. So in the context here, it'll be 3 Jan. I'm not going to worry about putting in the year because it doesn't matter that much. Stock price is at 1672. This will be starting just 100 shares. And there's no expiration on that. The basis is going to be 1672. So we can calculate the cost for this. You can automate all this stuff in a log, by the way. I'm not bothering to here just because it's a little faster to kind of run it quickly. But all I would do is have a space for us to quickly run through these. And it would be kind of like this. But I mean, this, we could literally just do the math, right? This, for this kind of trade, we know that the margin requirement is effectively going to be the total cost. And with the sake of the coverage triangle, in this case where we're not applying necessarily a momentum following approach, we define the risk as the entire size of the position. So this will be the first that goes on. So I'm not going to worry about cost. Actually, we will worry about cost. Yeah, we will worry about cost. So this will be 1672. The reason why I'm worrying about cost here is because it doesn't make a difference in this context, but other positions it will. And then this kind of stuff doesn't really matter. I don't care about days to expiration. We can get rid of all that for now. Okay. All right, so we have the very first position that we'll put on. And then let's add 2 more. We will need the strike price. And we'll need delta. So this obviously won't have those. Okay. Now let's see if we can find a put in here that'll work. I'm going to move this out of the way for now. And let's take a look at what we can find. This is old. Let me just reset this. So nothing's in here. We'll go to 17 Feb. So in 17 Feb, we'll be able to get the 15s. Those are going to be a 30 delta. And the way that I would do this is like a 15 put premium. Let's call it $1.20. Whenever doing this and you're effectively simulating options positions like paper trading this way, one of the things to always keep in mind is you should be giving yourself unfavorable fills pretty much always. So you can see that it's bid 119, offered 124. You could realistically likely get a better fill than that, but I'm not going to bother. What I'm going to do is position myself so that I at least am looking at this in the more likely context of what it likely would look like. That's the way that I'm thinking about it. So for the rest of these, we'll calculate the stuff from here. So we know the margin, 1,500, not 99. And for the cost, this will be I'm going to do the math in this one since most of these will be options going forward. So we'll have size, premium, 100. So this just represents what we're taking in. The way that I would run this kind of log is these would be negative if it's money out. So the premium on this one, I would run it this way so that I know that this is a debit. I didn't bother doing the math on this one simply because the stock transaction's different. For those that are wondering, oh shit. For those that are wondering, a way that you can do this that's pretty efficient is you can just set different if-then rules for your cost calculation. So for example, you could say like, if there's a size, but there's no strike, then this is equity. And this is how you calculate equity, which would be size times premium. If you guys want to go through that detail, let me know. I'll literally show you how to do it yourself by querying ChatGPT so that you can learn how to do it. If you don't care, then that's cool. We just know that you could do that. All right. Percent capture doesn't matter that much. Stock move we'll figure out later. Okay, Reese votes for that, which is completely cool. Let's do that super fast. It really won't take that long. So I'm grabbing Gemini just because it literally happens to be up. So I would tell it in, where is this? In Google Sheets, cell N76. I want to calculate the cost of a position input, but differentiate between options and equity positions. Write a formula that first checks whether the position is an option or equity by looking at D76 to see if it's blank. If not blank, then check F. Doesn't really matter. You could also use E. Then check E76 to see if there's an expiration. If there is no expiration, it should be classified as an equity position. The cost calculation is D76 times H76. If there is an expiration, it's an option. The cost calculation is D77 times H77 times 100. Pretty much it. And out of curiosity, I'm going to take this same prompt. I'm going to drop it into ChatGPT because I also have that up. I just want to compare what they give us. You guys know I typically like to do this. See, this is why I like to do it, because they're two different things. This is what ChatGPT gave me. And then this is what Gemini gave us. So let's see. So it's checking for blank. This is using different functionality. And this is saying Excel. So this might be defaulting to Excel when it shouldn't. But if is blank is still a function in here, which is fine. I actually like what this came up with better. So let's jump this in. It should be negative 1672. It is. If we drag this down, it should be 120. It is. So the formula works great. Done. Done and done. Reese says, damn, the advantage of AI is when you know exactly what you need. I meander too much. So let's say you didn't know what you need in this scenario. And let's say that you needed to reason through it like more carefully. Let's do... it doesn't really matter. Yeah, there's not like a good example in here, to be honest. I was going to do one where like we're filtering whether it's a put or a call. But let's say that you needed to figure out how to do that. Here's what I would say. I'm just going to put it in S. So in S76, I want to indicate if an option is a put or a call. In F76, I input the strike followed by C or P. C for call or P for put. How can I differentiate and actually spell differentiate correctly? How can I differentiate if it's a call or put in S76? And what it'll do is it's just going to use some sort of right formula. That's all. So it'll pull from the right. It'll check if it's a C or if it's a P. And then it'll say like if C, then call, if P, then put. But we'll see what it gives us. But Reese, that's exactly correct. What you need to do, right? So you can see exactly what we know. Now, what it's doing is what I don't want, because it's simply checking only if it's C, which this can give us an issue further down the line if we want to do something else. I would make it more specific. I would say, I don't want to just check if it's C, and if it's not C, assume P. I would want it to be check if it's C or check if it's P, and then align both. But it doesn't really matter. The way to think about, it's so funny, the way to think about prompt engineering, it's literally the same exact thing as trading. All of the work is done in the prep. So if you just throw in like lazy inputs, the only thing you're doing is making it longer for you to eventually get to where you want to be anyways. So the upfront investment in like carefully thinking through what you're trying to do is pretty much always worth it. Pretty much always worth it. Okay. So now we have our put on. What we need to do here is calculate how much money is being used. And then we also need to calculate how much risk is out. Because as we know, this is going to be a limiting factor. Meaning the number of positions we can actually put on. So right now, margin and risk are the same. Again, for the reasons I was explaining before, these are going to be the same because these are defined as the cash requirement. So now we need to get and figure out if we want to put our call on or if not. I actually see that we're a little underinvested, where as of right now, especially with the smaller account, I wouldn't want to leave a ton of cash sitting to the side. I would like to keep a little bit of money sitting to the side if possible. So what that means to me is I don't necessarily want this to be $3,500, what I see here, but I also know that I would prefer not to cap the upside of these options when I sell a call. So we're going to see if maybe instead of doing 100, let's see if we do 125. And let's see what that does to our total picture. It puts us like right on target. So this is probably what I would do in this scenario. This is suboptimal. And the way that I would be thinking about this $5,000 portfolio is that if I'm doing what I should be doing and aggressively saving every month, this should continue to go up so that then I can filter more capital to be able to build into these positions over time. This is just, again, this is the game of trade-offs, and this is a pretty big one. because you're between a rock and a hard place. You don't want to use all your money up front, and certainly not. But we also do not want to have capped upside. So maybe we'll see if we can just do like 110. That takes us to 1839. That gives us like $150, which isn't much, but it's something. So maybe that's what we'll do. Instead of doing 125, we'll do 110, something like that. If I were doing this for real, this is the structure I would use, because in my mind, next month, I'm going to have more money to put into the account. That's equally as important as anything else we're doing right now, is the saving component. So we'll proceed this way. So now we know that there's another thing we have to do quickly, which is include our short call. So let's figure out where our short call is going to be. And we'll do something like the 21, and we'll get 59 cents. And is that a 30 delta again? The 25 delta. And we'll get 59 cents. The margin for this trade would be blank. There's no margin requirement because the short call is tied to the rest of the position that you see here. So there's no additional margin requirement at all. Okay. So now a couple other things that I would track is whether or not these are like what my total debits and credits are. So the way that we can do this, again, we can grab Gemini or whatever flavor you like. And again, if you don't know how to do the formula, it's super easy. We're going to say in cell N74, I want to calculate, or I want to sum all of the negative numbers from N76 to N. Let's see what it gives us. I'm going to open the door for Thor. He's very excited to be here. So this looks completely correct. So we'll just dump this in. Boom, we got our number. So now you don't need to ask it again, right? Like you can reason through what this would be over here, that it needs to be greater than 0, right? So the reason why I say that is like, as you're doing these different formulas and stuff, I wouldn't get to the point where like you ask it to do everything. I would still actively be trying to think through it myself, because there's a lot of value in that process. Okay, so we know so far that our total debits, like the money that exists out, that we've bought outright, is $20.90. Credit, we have $179 in. So what we can do is we can figure out what our credits are relative to the total portfolio size in terms of a return. And we're already at 3.58% return, which is massive. That's a big return. So again, if we were to annualize 3.58% over the course of a month, 3.58%, that's a 52.5% return. So we don't really need to add more risk here, although we can and we should. So now let's actually see if Gemini can help us here. What I want to do is ask it for a list of stocks that are like sub $100, right? Because that's the hardest thing to do in this scenario, is like the active scanning process that I would do, because it's scanning back in time. So actually we can just, I think the watch list will be better for this. Let's use the watch list. So we have our first position on, great. And we're looking for more. So we should, as always, go to Ford, because Ford is like the Toyota Corolla of the stock market, meaning everybody who's poor trades Ford at some point, and it's just because that's how it goes. So Ford has had kind of like this triple bottom. I don't love this broader trend that you're seeing from 22 into 23. So this is the kind of thing where, like, at least in the beginning, if I were to trade it to the upside, it would be very, very cautiously. But this is just not what I would pick yet. So we'll add this to a watch list. So let's add, I don't think there's an alert thing. So we'll have to check back. We'll have to check back on how it does really above this level. If it starts rallying strong on volume above 1230, then maybe. So let's see if we can find other relatively cheap stocks. If there's stuff that you have in the top of your mind that you think might be decent, let me know. NLR, this one looks fine enough. Real estate, don't love. Now, what I'm looking for here is actually stuff to be able to sell some premium in. That's the idea here. XAR, XBI, XRT. So right now I'm just flipping through the watch list, looking for stuff that's weak. Lauren says Ford is boring. Ford is very boring. But what's fun is making money and then using that money to do stuff you enjoy. So I will fully grant to you that Ford is boring. It most certainly is. But I also personally wouldn't care if Ford is boring. As I try to remind traders, like in the beginning, the entire goal of what we're doing is to make money. So yeah, I don't disagree though. Ford, it's massively boring. Jaden says SYM. This is like $12. Okay. So what do we see here? And then it looks like you guys also mentioned CCL. So we can take a look at that as well. I wouldn't short this yet because of like this little bit of a recovery rally. So we can add this to our watch list. Let's check CCL. This looks interesting. So CCL does look a little bit weak here, but I feel like this post earnings rally, it's a little too early because it kind of held this support level. So I would wait here as well, probably. Let's check SoFi. SoFi is kind of interesting, and SoFi is also super cheap. SoFi is one of those names where if we wanted to trade it, this is kind of cool because it doesn't take a ton of money. But I would trade this to the long side personally. So maybe, I mean, we don't have to do a short. We could do a long. The reason why I like this is because I would consider this a pretty low risk entry. Like our stop would be at below 422, so call it like 415, which is a tiny move relative to where we are. So that kind of, even though it might look a little bit better to the downside, which I'm not really convinced that it does. Right now, it looks like it's mostly consolidating. This I would consider to be a high probability, but a low risk entry. And I have no idea what SoFi did this year. So this will actually be kind of a fun experiment. So let's see if we can build our ratio call diagonal in here. Something like SoFi, let's see how it moves. $13, $16. It kind of goes through these surges. but they happen pretty fast. 14, 17. That's 2 weeks. 3, almost a month. 2 weeks. Who knows what I'm doing right now? Why am I doing this? 8 days, a week and a half. Why am I bothering doing this? Any guesses? Chase says no idea, which is fair. It might seem like a strange thing to do, but there's a reason. Lauren's got it. Good job, Lauren. That's exactly correct. So this shirt has like hair inside of it, so it's like super itchy. But Lauren is exactly correct. Lauren says DTE. What I'm doing is I'm trying to get a sense of what DTE makes sense for this thing based on how it moves and what I can determine for it. So what I'm noticing is a lot of these big moves are like pretty explosive, right? This is 20 days. This is a month. So my expected holding duration for this wouldn't be super long. Maybe a month and a half if it's long. So that tells me a lot about what expiration I would want to go into if I'm maybe planning on holding for like 45 days. I typically don't like holding long options as they come within 50 days. Definitely like that's on the tight end. So this one maybe like the 108, but I wouldn't put that on just yet. Right now it's consolidating. This is another one that I'll add to our watch list. So we have Ford on our watch list. We have SoFi on our watch list. This would be for like long calls. This would be for whatever we can get on in Ford. So let's see if there's anything else that immediately looks good. If so, great. If not, we just add it to the watch list and then we'll fast forward some time. Let's see. Bets. Bets is an interesting one. I don't know how liquid it will be for us. Why not says did well on SoFi and Rivian. Don't tell me that. I don't want to know what happens. The whole point of doing this is to fucking figure out what happens as we go. So this one is super interesting. This one is also too early to tell. I would trade this potentially in either direction. It seems like in the longer term, maybe downside, but near term with this kind of like rally out, it's really hard to say because this looks like some sort of news-driven sell-off. I just don't know what. So nothing sticking out to me here yet. VNQ, maybe. FXE looks really strong. What is this? EWZ. So what I'm doing is I'm just trying to get some context for what the market looked like at this point in time as we're just kind of, perusing through stuff. Reese says, seeing how quickly it falls, what to prepare for. That's sort of it. It's not fully it because, again, part of what I'm doing is I'm intending to use that information to help me figure out like what I might want to do. So I wouldn't like I definitely would say that's part of it, but not like not the main part. So this looks interesting, but again, like when you see stuff that's falling, when it's coming into these spots, this would be watch list material. And the reason why it's watch list material is it looks slightly favorable to the downside, right? Because it broke below this, but now it's really holding this consolidation. It's falling into it, but I would need to see it below it. So that I'm going to add to our watch list, EWZ. And then this would be something like call credit spread or some flavor of that. So as we're just casually looking through stuff right now, I'm just building a watch list for us to be able to circle back to a little more quickly as we're trying to see what's going on. So let's continue. And I'm purposely picking stuff that like I don't really know about, because some of these I know exactly how they did, which I don't want to trade them. See, this looks interesting. Apple looks interesting because this seems like it's like falling pretty heavy. Like that's a not insignificant down day. So let's see what the call side looks like here. And this is just to see, these are $5 wide. So this is immediately out of the equation. Next. Amazon, no way. Meta, too expensive. Netflix, too expensive. Goog, maybe. Microsoft, too expensive. Cisco. So Cisco looks decent here, I would say. It's funny because Cisco's actually rallying right now when most other stuff is kind of doing poorly. So let's see what we can get for like a put credit spread. At the 45 handle, you'd have to go $2.50 wide. And you get 52 cents. It's a little big. If I could get something closer to like $1 wide, I would like it a little bit more. But this is $2.50 wide, collecting 52 cents. So yeah, I don't hate it, but it's a little big, but I think we might be able to get away with it. Because that's risking like 250, 248 or whatever. Or 249. So let's see. Let's see what we can get out of this. Yeah, so it's 198. If we get filled there, we probably wouldn't. So let's call it at like 50 cents. Again, penalize ourselves a little bit. So it'd be risking $200 to make 50. So we'll see if we can make that happen. So let's add a couple things really fast. The first thing I'm going to add is just a spread calc. And the things that I want here, this is, again, stuff that I would make in a log just because I know I'm going to be looking at this stuff and I want it to be fast. So what I'm going to do here is I'm going to include size, width, premium. So this will be profit, potential. And then, well, we'll just do win. We'll do win size, loss size. So one of the things is by taking the time to build these little tools, again, it's a little bit of a investment up front, but once it's built, right? So like we're talking about doing a one lot. The width here is $2.50 wide. The premium we're talking about is 50 cents. So what we can do is we can make it so that we just give it these handful of inputs and we can calculate not just the win loss, but we can also calculate the expected return, which again on spreads is typically going to be negative, but we want to see how much of how negative it is and how good, because we're trading directionally right now. By selling a put spread here, this is not like I don't have an opinion, or I think, I don't think direct, like you're thinking directionally. You don't get to not think directionally with the vertical spread. So anyways, the total win size here is just our premium times size times 100. I don't know why I added a parenthesis, just because felt good. And our loss here is the width less premium times size times 100. And then we'll just throw a negative in the front here. So the purpose of this is now, as we're evaluating any other spreads, we just do it super fast. Now, the other stuff we can throw into here again quickly is we could do probability of a win, probability of a loss. Probability of a win in this case, we can either use delta or we can use the actual calculated probability. So the probability is 34% chance of being in the money. So the way I would do this is like this. Probability of losing is 34.17. This isn't necessarily a max loss, but this is the probability of losing. And then this is just one less this. So now I have a quick look at what the probabilities are. And then again, as you know, now we can calculate the expected return just so that we know. We already know it's going to be negative. Well, we don't know, but pretty good suspicion that it will be negative. So this will be the win size times our probability of a win plus loss size times probability of a loss. So this is negatively expectant 35, which again, fully, that doesn't surprise me. Vertical spreads are very often going to be this. Just because this is negative expected value doesn't mean it's a bad trade, but it does mean that there's no inherent edge to it. It means that you have to be the edge. You don't just get to put this on and it'll work and you'll make money. You have to be directionally correct for this trade to work. So with Cisco trading where it is, I would take that directional bet. So let's put the trade on. So 3 Jan, Cisco, stock price is 47.42. We're going to be doing a 1 lot. Expiration, I think, is the same. 17 Feb. And for this, since it's a spread, it'll be like the 45.42.5 puts. Delta, I'll just use the short. It doesn't matter. If I wanted to do both, I would just do like 0.3/0.17. And again, you can deconstruct all of these and whatnot, so it doesn't really matter. So premium here, we're planning to get good old fashioned 50 cents. We already know how much money this is going to take because we can see what the loss size. Now, again, another cool thing you could do is see what this loss size is relative to your portfolio value and just leave this sit here. So this is risking 4% of the portfolio. That's a massive amount of risk for this kind of spread. Like in a regular size account, there's no world where I would ever do this, but this is a small account. You have to make concessions. It's the only choice you have. So this is 3 trades. We're using a decent amount of the account, not a ton, but definitely a little bit more than I would typically care to use. So right now, 75% utilized. And then again, this will be, the amount of risk will change a little bit. What the fuck did I just do? No, stop that. Stop that immediately. There we go. Because these should be the same right now. Okay. All right, let me take a pause yet again and see if there's any questions so far with what we've set up, how we've set it up, where things sit right now, anything like that. I still really want to try to find a short trade. There's got to be something that looks good for a short. Give me a second. In the meantime, if you have a question, let me know. Just feel like there's got to be a short somewhere. QCOM. How do we feel about QCOM? It just, everything is consolidating. Everything. AbbVie consolidating. J&J consolidating. Pfizer fucking consolidating. Pfizer's kind of extended though. So maybe there's something here. Maybe this isn't necessarily like a pure short expectation, but there might be something here. I'm thinking it more so in the context of it peaked here and then it's consolidating lower. So we'll take a short here. Why not? Let's see what we can get for these calls. We have to go 2.5 wide again. And again, we're going to be directional. So premium here is 60, call it 68 cents. Probability of losing 34.9. Which you'll notice this actually has a slightly better, take a look at that. Our EV just went up pretty significantly over what we just saw from Cisco. That's kind of curious. And it's essentially the same probability, but take a look. This is a 38 delta compared to what we got over here, which was a 30 delta. That's actually interesting, and it makes me like this trade more. So PFE 50.95, size 1, expiry 17 Feb. Now we're looking at the 52.5 55s. So 52.5/55. These are the calls. Delta is 0.38 by 0.2. Premium is, again, we're calling it 68 cents. We know our risk in the trade is 182. So now we're 80% utilized. That's beautiful. That's like a pretty good spot to be. And we're looking, again, if we were to plot out our return target for the year, we'll just do 9%. We'll just pick the midpoint. So you can see, like, we're already well on the way in terms of what this might get us. And again, this is not including a return potential on the long shares. This is just using a return potential based on the credit that we've taken in so far. So this is almost like what we're trying to get over the full year. Now, we don't expect this to happen, right? We fully anticipate the probability of stuff going wrong to be pretty high. Such is the nature of trading. So now let's just fast forward time. Let's see what's up. So now I'll bring us forward. I don't want to go full weeks because I wouldn't wait that long to do stuff. So we'll skip days. We'll do like every other day to start. Huzzah! Pfizer trade already looks good. And this is starting to break down more. So this almost starts to become interesting from a couple other ideas. One thing that I would be consulting with that I just can't right now based on where the platform is just implied volatility percentile and rank. Like, I can't see any of that. So I'm just using the options chain to proxy it. But I would want to use that for sure. But these are still mostly directional plays. Okay. So Pfizer, where do we sit right now? We had the 52.5s and the 55s. we sold those for 68 cents and it's already at like 34. So those might need to come down soon, actually, but not that soon. We still have 20 deltas on the short, so we can wait a little bit on Pfizer. So nothing doing there. Let's go to Cisco. I'm just going to go backwards. So Cisco is going against us. We have the 45, 42 half put spread. We put that on for 50 cents. We're down here in terms of the short strike, but there's just nothing to be done right now. This is just let it sit. TQs is sideways, nothing to be done. So let's go to Monday. All right, so TQs, we're starting to see a little bit of a rally. There's two things we might have to do here. The calls are good. We're at the 21, but I really wouldn't want to get ran over. So gonna have to pay pretty close attention to those calls, I think. And then the put, we just need to see if we need to rebalance it. One of the things to keep in mind is with something that's at these price levels is you're gonna run out of the ability to short puts super fast. Right? So think about it. The original put that we sold was at the 15. So as TQs might make its rally, and I don't remember exactly the path it had for the beginning of the year, but as this has its rally, what's going to happen is even if we try to rebalance the deltas on these, let's take a look. So we're at the 15 put, right? We're already down to 17 deltas. That started at a 13 delta. We lost half our deltas right away. I would want to rebalance this. The problem is if we bring it back up to the 17s, what just happened? We now just add another $200 to this trade. That will put us at our total allocation available for the trade, literally right away, which is extremely suboptimal. And again, it's why saving and all this other stuff is important. So a trader is faced with this kind of thing with a very difficult situation, in my opinion, because you either have to just buy the shares outright and just hold it until it comes back down, or you sell the put, buy the shares a little bit later when they're a little bit more expensive. Now, just understanding the fact that this is kind of a ticking time frame and you are running out of the choices available to you pretty quickly, I would probably favor just buying shares. I would prefer to be able to sell the puts, but they're going to end up taking way too much of the account unless I decide to give myself a little bit more on the core allocation, which might have to happen. I might flex a little bit here because we can see from the speculative allocation, we're not using anywhere near this amount of money. The total sum that we have on right now is $382 of risk relative to the $1,500 that we're expecting to use here. So we have room to play. So my game plan here will probably be to roll these up to the 18 or to the 17, to the 17, I think here, because that's going to give me double the deltas that I have. Well, not double the deltas, double the premium that I have, and almost double the delta, which I need. Otherwise, I'm going to miss the directional move, which I don't want. So let's go to 9 Jan. Let's take a look at the price. It's $18.92. And these would be closed at 57. So now, again, we can do all this different math. I don't care about the capture. The rest of the stuff is okay to track. So the stock move is easy. It's just this minus this divided by this. So stock is up 13%, which is pretty significant. And then these two I'll actually flip. So P&L, we have our closing plus what we opened at. times size times 100. This doesn't differentiate for long shares just because I'm not wasting the time on that. Didn't mean to do that. So that gave us a 4.2% return on invested capital. So there's our first put that's out the door. Now, again, another thing that I would do is I would modify the formula so that if there is a closing price like this here, don't count the margin or the risk input. So that this way I could easily update this without having to spend a bunch of time. So we'll do that super fast. So we'll grab Gemini again. And then essentially I'm just going to say, modify this formula so that if there is an input in M, that row is not calculated, is not included in the sum. So again, this is just literally plain speaking to GPT, telling it exactly what we want. It's using not blank, which is fine. That's, again, error prone. It's not exactly what we would want, but it works just fine. So we're cool here now. So then I'm going to tell it to do the same for this formula. Or again, you could just copy the logic it did. Do the same for this formula. So now, as soon as I input the close, I don't have to like go back and delete it, which I don't want to do. Because again, if you go back and delete it, you're deleting useful information. So your goal is to preserve your inputs as much as you can because it's going to help with analysis later on. So now we're 50% utilized. We need to put on our new short put here in TQs. Let's get Gemini out of the way. So this will be 9 Jan, TQs, stock price is at 18.92. We're going to do a one lot. We're still going to be in 17 Feb. And now we're looking at the 17 put. That's going to give us a 29 delta. Premium that we'll get on that put is 111. And we're going to put up 17 Hundy to do it. Cool. Okay. So we have our trades. We can look for more, that kind of thing. I'm going to fast forward time just so that we can, because I know that we're pretty deep in this. We're already an hour, 15 minutes. So let's just, I fast forwarded a little bit more time. Bummer. So at this point, our short puts will be doing really well, but we kind of missed our opportunity to buy shares, at least to get another smooth 100 lot. We're too late now, which sucks, but is what it is. So let's take a look at what these are trading at now. The 17 puts, they're down for 30 cents, down at 11 delta. If we rolled them up to the 20, that takes us another $300. So that would take us to a total of 4,090. That's 90%, right? So we're out of the put game here, unfortunately. So here's what would happen next in my approach to this kind of thing. This would come down. Stock is now at 21.66. These are going to come down for, what did we say, 30? Yeah, let's call it 30 cents. And really the only thing we can do at this point is buy shares with the residual allocation that we have, as much as we want to use. So $3,500, we're only using 2090. So we know we're not going to be able to sell more puts. So we might buy another we have $1,500 left, maybe 750. Because this is also knowing where TQs is, the distance off of near-term highs puts us at pretty low point. So this is 23 Jan. T-triple-Qs stock price is 21.65. Size, we'll have to figure that out. It might be like 25 lot. There's not going to be an expiration. And 21.65 should be 66. So maybe 35, 34, 34. So we get 34 shares. So now our total position here, 736. 736. So now our entire TQ's position is effectively set, except we need to manage these calls now. So the calls are officially a point in the money. So this would be 23 Jan. This is too late. This would have been managed earlier for sure, especially when you have like a smaller amount tied to this. So just is what it is. So 21.66 is when we're managing these. And then our strike is the 21s. So we'll get those down for like $1.99. Okay. Next, 23 Jan, TQs, 21.66. This will be a one lot. We'll be in probably 17 March now. And let's see, we need to get at least $1.99. That puts us at the 22s or the 23s if we accept a small loss. So let's see if we can get to those 23s. Those are a 46, so we're already getting buried super fast. And let's call it $1.60. So in the original, we got $2.19, closing it for $1.99, so we can make that move. So the margin on these would be nothing because it's tied to the underlying trade. And now we take a look at the others really fast, and then we'll just kind of talk about this process because it would just be this. Like over and over again now. So Pfizer, we got our down move for sure. Wow, that just absolutely broke down. So Pfizer, we're at the 52 half and 55. So these are down for nothing. So that comes down for a penny. So Pfizer would be down. And this is still 23 Jan. 45.2. And we'd get out of this for about a penny. Okay. So now what I would do is I would actually calculate this is wrong. Oh, because this is just calculating off the stock transaction. So what I would do now is I would change this formula. Oh, that's just our credit. My bad. One sec. We need to aggregate our P&L. So we need to essentially input a sum if we want if this is not blank. So we can, again, tell GPT exactly what we want. So P81, sum P82, it's P80. P80 sum P82. If M has an input. So this will sum our close trades. And again, you can just essentially use this logic, but. So this looks good. Needed to be blank. Yeah, this is good. No, that's not right. We want the sum. I want to sum P82 to P based on this filter. Gave two versions too, which is kind of interesting. I'm going to wrap this up once we finish just marking these trades where they're at. But if you have questions or if you have anything that you want to discuss more deeply about like this process, if some of what we're doing doesn't make sense, if you don't know how to apply some of what we're doing, now's the perfect time to start throwing those things into the chat. Let's just verify that this is correct. And it's completely correct. So this is good. So it's summing essentially what we have. And you can see we're still net positive even after this pretty big losing trade, realistically. And that should be there. So then we can calculate the return on the account so far, which is positive 1.42%. And we are 20 trading days into the year. Okay, so let's see the rest of this really fast. We really only have one other to look at, which is Cisco. And Cisco, I don't remember what we did. What did we do in Cisco? We're long. 45, 42 and a half put. How are we doing? Oh, we're like still right on the cusp. So those are 37 cents. We sold them for 50. That's leave it. That would be no change. Cool. So let's talk about and just kind of recap what happened here, right? What was this process of building the portfolio like? What decisions were made and why? And you'll notice that this is not difficult. It's really not difficult to follow exactly this. You can see literally together while we were on this, we built a rudimentary log with the key stuff that matters. This isn't everything, but it's the main stuff that's applicable to what we're doing. We have a useful side calculator that we'll use for one of the core strategies that we have. We have our watch list that we're following these different names to see which way we might want to trade them. And we have some portfolio level statistics. We have what we're trying to make on the year based on our input return target, which in this case is the midpoint between 8 and 10. And we're able, another thing that I would do is I would differentiate so that this could be more automated. Just differentiate and be like, have a flag if it's core or speculative, C or S, so that you can see your running totals of core and speculative. Make it a little easier to come up with those numbers. So I would just add an input for that. To make it even easier still, I would essentially make everything speculative unless it's core. This way you don't have to worry about inputting a bunch. So for example, what I would do is I would just have the core allocation calculate if the ticker is TQs, because that's what we're using for core in this scenario. And then if it's not TQs, then it's speculative. That's how I would think about it. So notice how we're not using the entire portfolio. You don't have to. Notice how we have a couple complementing positions. We have stuff that's short premium to the upside, short premium to the downside. We have our core position already built. And the game now is literally just cycling through and making the same decision tree that you've seen so far. Like that's literally it. That's all that goes into this. But there's a couple things that matter a lot to us to track. So for example, the risk. I would split the risk tracking out into two places: core risk, speculative risk. Because the core risk is going to be a dominant portion of this. The speculative risk will be a smaller subset, but I want to see how much of a subset that it actually is. That's useful information for me to track. Stuff like that. But the broader idea here is when you're trading a small account, it's annoying. There are disadvantages, but it's very doable. Notice how we use things like verticals, which I don't care for, but it is what it is. Because when we're trading vertical spreads in a small account, you're accepting the fact that it's not the most efficient expression of what you're trying to do. However, there's a trade-off, and it makes it fit the account better. Because remember, even when we're sizing stuff like this, $200, that doesn't seem like that much. This represents 4% risk on the entire portfolio. That's not a trivial amount of money that's being put at risk at the portfolio level for a vertical spread where you're aiming to make $50. So this is also why I think it makes a lot of sense to have buy-side strategies. And that's actually what I would have done after the first time advance, or maybe the second time advance. We could do it really quick now, just because we're here, so that we can at least close the loop on what this watch list looks like. John says, hope you're having a great... I'm having a perfect Friday. Sitting here, chatting about options. It would be a little bit better if it wasn't about a small account. That's kind of annoying, but chatting about options with the outlier community, it's the best thing you could do on a Friday. Love your channel. Thank you very much. I appreciate that. I hope that this stuff is useful. All right, let's take a look at these on our watch list really, really quick. Ford, we didn't have an opinion on. And it looks downside, but it held this. That's interesting. So we looked at it here. It rallied hard, consolidated, and is rallying again. So I would probably go upside in Ford if I had to pick. And then SoFi, we wanted long calls in here. Again, I think the spot we decided would be a breakout though, which would have been here. This is where that entry would have been. So SoFi would be long, some sort of call position there. And then EWZ was a call credit spread of some sort, which we would have been getting ran over depending on where it was. That would have been essentially a full loss though, I presume. I don't know what the vol would have been, but yeah, because I mean yeah, we were looking at a call credit spread. That's right. I remember now. Because of this initial drop, but holding this consolidation, it wasn't a fade or a long. I wouldn't have traded either way here, because I probably wouldn't have traded this to the upside. This maybe at this point could be something for like a call credit spread, but I wouldn't be convinced, because this here, it's consolidating super effectively. Okay. So this will be the last version of the surviving options with a 5K trading account that you guys see. And my game plan is now for the next one is to turn into the next main topic that we have talked about, which is taking a look inside the actual trading strategies that I use. The main purpose for that series is going to be actually just zooming in on how I build out what I refer to as like the strategy toolkit. And it's the way that I think about having things to be able to trade most market conditions. So we're going to be spending most of that conversation looking at it from that lens. It's less about what I personally do with my personal strategies, although we will talk about that. And it's so much more about how to build a strategy toolkit that allows us to trade varying market conditions. That's the main idea. So, let me see what you guys have in the chat. And then again, if you guys have any questions or anything that you want to talk about, now is literally the perfect time to throw those in, and happy to spend a few minutes while we're waiting for our dinner to get here. Actually, let me finish making my dinner order. All right. John says, do you still like Box? That's the best savings account kind of ticker of all time. I never really felt anything about Box. Nothing that I trade. And it's because what you get in Box is a little bit different than what you can get without using Box and just trading box spreads yourself. So I personally wouldn't use this, although if you guys haven't seen, I had my friend Wes. He's the dude that made this. I had him on the podcast. He's a Marine veteran. A super smart dude. He's a PhD. He's actually, I'm due to reach out to him to get another episode with him at some point, because I like connecting with him. He's a really cool dude. But yeah, I mean, I just use box spreads, because if you take a look at like the holding duration versus what you can get on, where is, I think I have the box spread calculator in here already, if I'm not mistaken. I do. Oh, this is just comparing the yield curves. So if we look at a current box spread, let's see. Let's see what we can find. I just want to price stuff out. Okay, I was going to move it over. It's kind of difficult. I'm going to do the math first, and then I'll pull it over so that you guys can see. I'll do like a one lot. So let's say today is 6th June. And let's say that we want to put on a box spread. Let's take a peek. So let's say we want to go out here. That's over a weekend. I would want to come out a day earlier if possible. We'll do like the 15 July. So let's see what we can get for just a standard box spread. We'll keep this at 75 for now. Might be okay. 55. Yeah, this is fine. So let's buy, sell, 65, buy, sell, analyze. So right now the mid is 996.15. Probably wouldn't get a fill there, but let's see. So on a one lot, using 5,500, 6,500, tracking the net premium out to start as 996.15. That, yeah, there's no way you'd get a fill there. That puts us at a 5.72% premium over the risk-free rate. The total loan out there is just $99,615. So assuming $100,000 overall idea. The corresponding, I need to update the current risk-free rates though. And again, those that are in the pro side of stuff, you guys have this already. This is just a template that you can download. Okay. So now we have a slightly different picture. It's 5.81% because the yield curve did shift slightly, which is actually kind of interesting. So what I'm doing is I'm just updating what the yield curve shows us. And it looks like interesting. It looks like a modest shift in the front. That's kind of curious to me. Anyways, so let's, yeah, so anyways, like when I look at trading a box spread, this is more or less why I prefer to trade box spreads outright, because you essentially are going to get a better, you're going to get a better rate just by trading it yourself, which I think is at least what I tend to prefer. Yeah. Interesting. The curve shifted, like not a ton, but a little bit. So like the front was 4.335. Now it's at 4.224 for a month. It's not an insignificant front shift, funny enough. So anyways, yeah, that's why I prefer box spreads personally. Chase says, is part one available? Yeah, so part one, you actually have to skip through a lot of it. Where's part one? Here. Part one, you have to skip through a lot of it because we had like a conversation in the beginning about what we were going to focus on based on a couple polls that we took. So I would start it at, well, I'll tell you right now. Let's see. So here we are. This is so we want to start, I think, here. I don't know. There's actually, wait a minute. This is this one. What the fuck? I was like, what's happening? It's so funny. Like, this is straight doppelganger. All right. This is the right one. All right. All right. So we want to start from like here. I would say like 28 minutes in. That's where I would kick off. Cool. I updated the timestamp in there so that you'll be able to see exactly where to start. All right. Black Mama says 5K is really hard. I've made challenges from 1 to 2 A+ setups. I actually don't like, that's the thing is 5K really isn't hard. The hard part with a $5,000 account is a trader wrapping their arms around what's realistic. That's the hard part. Because you can see, even in the example that we just went through together, if we take a look at the realized returns here, and this here, $71, 71 gross dollars is probably the most disinteresting and unappealing return on planet Earth, right? Like, nobody cares about that. However, in the context of like an actual market return, that's not bad, right? 1.42% return over the course of a few weeks is not bad. So I think that's probably one of the biggest struggles people will go through. The implementation of a $5,000 account really isn't that difficult. It's just a matter of accepting those trade-offs. The hard part is for somebody to be able to look at something that was going to make them a bunch of money really fast and easy, that doing that and saying something like a 1.42% return getting you $71 is good. I think that's the real hard part for people, which totally understand. Like that's difficult to swallow. John says, I really want your look at AR and nat gas. We'll probably do that on maybe the Monday stream, but yeah, I think box itself is fine, but I would just trade box spreads outright myself. You'll get a better yield. That's the function. Black Mamba says it's hard for an experience for a pro. It's okay. Each mistake can end in a blow up. These are facts. Yeah, but that again, like that's the point, is that if you manage your expectations, none of these, if we even experienced a full loss, would blow the account, right? Like that's actually the entire point, is that this pads you. So even if we lost our entire TQ's position, which is the largest position this would have, we still would have just under $2,000 to use. So again, that goes back because each trade you put on needs to be thought through so that it is not that. Because for a lot of people, they're just so focused on how much money they think they're going to be able to make from a position that they don't spend enough time looking at even this, like we talked about, right? These vertical spreads. The vertical spreads are shots. They're directional trades. It's you could be right, could be wrong. It's like 50-50 shot. However, if we size these smartly, even if we lose on them, it still gives the portfolio a large enough chance to be able to put more on for the numbers to kind of break out a little bit better. So the thing here is most people that start with a small account just start with the completely wrong expectations, which is really what the first session was about, right? The first session, I don't remember where it is. I thought it was somewhere around here. No, here. So if you take a look at like what actually matters, if a new trader is able to wrap their arms around like what actually matters, then running a 5K account really isn't that difficult. But the problem is most don't. And most people who start trading options just kind of flop around haphazardly. Black Mama says inexperience will deteriorate and lose the account. A pro will handle most of 5K are used by unexperienced. It is what it is. Yeah, no, I completely agree. I think but that's the whole point of the segment, right? Is because for a lot of people, the reason why they approach it that way is just because they don't know better. And I remember when I first started trading options, I didn't know any better. So yeah, completely agree though. And that's the undoing of most traders, even people with bigger than 5K accounts. It's just, to your broader point, way more tied just to the experience element. And people who are inexperienced tend to think that trading is going to be fast, easy money. And again, as soon as you're around for a little bit, you know objectively this is not the case. And I think the main issue that people with small accounts tend to have is really, really fucked expectations that then ends up being their undoing unnecessarily. Simply if somebody just knows a little bit better about the reality of what this thing is likely to look like. So yeah, I agree though. It definitely is. It's challenging because there's a big pill that has to be swallowed that nobody likes. That's the issue. But cool. All right, gang. Hope this session's useful. I hope this, like the mini series at least, gives you some ideas on different ways to approach trading a 5K account. Again, today we literally just built a portfolio together back in time from scratch. And you can see it didn't even take that long doing it in an educational concept like this. We're an hour and 40 minutes in. So it can be done relatively quickly. Now, obviously it's quick because I know what I'm looking for and I know what I'm doing. But the broader point is like, it doesn't have to be this crazy, overwhelming thing. It just needs to be something that's thought through at a relative level. And if you can do that, then you can position yourself to be in a much better spot. And again, you'll notice that a big thing that I always talk about is paper trading, because even if you're actively live trading a 5K account, the way to think about it is you're just learning the basics. That's not going to be done to scale the account massively. You're just getting a proof of concept. So you should still be doing that with a paper trading account in parallel so that you can test different things, test trading more so at scale, that kind of stuff. But as always, if you have any questions, you can hit us up in the community. The link to join is in the video descriptions for those interested. It's for free. Be an outlier. See you guys later.